The announcement of sweeping new auto tariffs by President Donald Trump marks a dangerous escalation in global trade tensions, one that is poised to have devastating consequences for consumers, businesses, and the broader economy. A 25% tariff on all imported cars and parts will not simply inconvenience foreign automakers. It will send shockwaves through the entire supply chain, raising costs, reducing choices, and potentially crippling industries both at home and abroad. The decision, driven by a desire to force automakers to relocate production to the U.S., ignores economic realities and could set off a retaliatory trade war with lasting repercussions. The impact on American consumers will be immediate and severe. At a time when inflation remains a pressing concern, the auto tariffs will add thousands of dollars to the price of new cars. Unlike previous tariffs that primarily targeted individual countries, this move applies to nearly every major auto-producing nation, ensuring that costs will rise across the board. Even vehicles assembled in the United States are unlikely to escape unscathed, as the majority of cars built domestically rely on imported components, from engines to transmissions to electronic systems. The unavoidable consequence is that car buyers will be forced to pay more, with some lower-income consumers potentially priced out of the market entirely. The broader auto industry will also suffer. The tariffs are a direct threat to the integrated North American supply chain, which has operated for decades as a seamless network under agreements like NAFTA and the United States-Mexico-Canada Agreement, USMCA. Automakers rely on a complex web of suppliers, many of which are based in Canada and Mexico, where critical components are manufactured before being shipped to U.S. plants. Disrupting this system does not simply create minor inconveniences. It introduces inefficiencies that could make production unprofitable. The result will be fewer cars produced, fewer jobs, and ultimately, a weaker auto industry overall. The stock market's immediate reaction, sharp declines for General Motors, Ford, and Stellantis, as well as major losses for Japanese automakers, reflects the deep concern over the policy's long-term implications. Industry experts warn that companies will not be able to simply shift production overnight. Building new factories in the United States would take years and billions of dollars in investment, costs that would inevitably be passed down to consumers. Meanwhile, manufacturers facing higher tariffs on imported parts may be forced to cut costs elsewhere, potentially leading to layoffs and production slowdowns. Internationally, the tariffs are already triggering fierce backlash, raising the risk of a full-scale trade war. Canada, one of the United States' closest trading partners, has condemned the move as a violation of existing trade agreements and has hinted at retaliatory tariffs. Similar sentiments have been expressed by officials in Japan, South Korea, and the European Union, all of whom have warned that punitive measures could be forthcoming. The potential for a global tit-for-tat escalation could further destabilize international markets, damaging industries far beyond the automotive sector. Despite these risks, Trump has framed the tariffs as a win for American workers, arguing that they will force automakers to shift production to the U.S. and create new jobs. However, history suggests otherwise. Past attempts to use tariffs as a tool for economic coercion have often backfired, resulting in higher costs for domestic manufacturers and job losses instead of gains. The 2018 steel and aluminum tariffs, for example, led to widespread industry layoffs as companies struggled to absorb higher costs. The same dynamic is likely to play out in the auto sector, with companies forced to cut jobs or raise prices to compensate for the increased financial burden. The potential damage extends beyond the automotive industry. The United States exports millions of cars each year, many of them destined for Canada and Mexico. If these countries retaliate with their own tariffs, U.S. automakers could lose access to key markets, further straining an industry already facing economic uncertainty. Part suppliers, which employ hundreds of thousands of workers, could see reduced demand as cross-border production slows. Even industries indirectly tied to the auto sector, such as transportation, logistics, and retail, could experience ripple effects that weaken the broader economy. Perhaps most concerning is the uncertainty this policy introduces into an already fragile global economic environment. The unpredictability of Trump's trade moves, coupled with his administration's willingness to disregard existing agreements, sends a chilling message to international businesses and investors. Stability is crucial for long-term economic planning, and sudden, Sweeping tariffs create an atmosphere of uncertainty that could discourage investment and slow economic growth. The United Auto Workers (UAW) leadership has come out in support of the tariffs, seeing them as a way to protect American manufacturing jobs. However, this perspective overlooks the broader economic impact. While a small number of jobs may be created in the short term if automakers are forced to shift some production to the U.S., the overall disruption to the industry is likely to do more harm than good. A weakened auto sector, rising consumer prices, and retaliatory trade measures could ultimately erode any gains, leaving American workers worse off in the long run. The bottom line is clear. These tariffs are a reckless gamble with potentially disastrous consequences. Rather than strengthening the American auto industry, they threaten to make cars more expensive, reduce consumer choice, destabilize supply chains, and spark international retaliation. In an interconnected global economy, policies based on economic nationalism often do more harm than good. If these tariffs remain in place, the cost will be paid not by foreign automakers, but by American consumers, businesses, and workers. What is being framed as a bold move to revitalize domestic manufacturing may instead prove to be a self-inflicted wound, one that could take years to heal.